Markets don't care about your feelings. They never have. They never will. You place a stop loss. You think you're protected. You think you're safe. The market hits your stop, takes your money, then reverses exactly where you predicted, every single time. It's not bad luck. It's not coincidence. It's design. The game is rigged, but not the way you think. Your stop loss isn't protecting you. It's painting a target on your back. Today, everything changes. Today, you learn what professionals actually do. Today, you stop being the sucker at the table. Part 1. The stop loss. Illusion. Let me tell you something nobody wants to admit. Stop losses were sold to you as protection, insurance for your trades, a safety net beneath the tightrope. But here's the truth that keeps me up at night. They're not designed to protect you. They're designed to extract money from you systematically and efficiently. Think about how a stop loss actually works. You buy a stock at $50. You're bullish. You believe it's going to 70, but you're scared. Someone told you to always use stops, so you place one at $45, 10% down. Seems reasonable, right? Seems like smart risk management. Now, here's what actually happens. The market makers see your order. They see everyone's orders. Not individually maybe, but they see the clusters. They see where the stops are stacked. $45 has a massive pile of stop losses sitting there. Thousands of them. Maybe tens of thousands. What would you do if you controlled the market? If you had the capital to move prices, you'd push the price down to $45. Trigger all those stops. Buy all those shares at a discount. Then let the price run back up. It's not a conspiracy theory. It's basic market mechanics. It's how liquidity works. It's how professionals make money from amateurs. I've watched this happen hundreds of times, thousands of times. The stock is trading at $49, strong support, good technicals. Then suddenly it drops to $44.50, massive volume spike. Then immediately back to $49. What just happened? Stop loss hunt. They call it a shakeout. They call it volatility. I call it theft with permission because you gave them permission when you placed that stop. But it gets worse, much worse. Stop losses create a false sense of security. You think you're protected, so you take bigger positions. You risk more than you should. You get comfortable. Then when you really need that protection, when the market genuinely crashes, your stop doesn't fill where you wanted. It fills 10% lower, 20% lower. I've seen stops placed at $50 fill at $35 in a flash crash. Your protection evaporated exactly when you needed it most. Here's another problem nobody talks about. Stop losses force you to realize losses immediately. You place a stop at $45. The stock hits 45. You're out. Loss locked in. No recovery possible. But what if the stock bounces back to 55 the next day? You just lost money on a winning trade. You were right about direction, right about the setup, but wrong about timing by a few hours. Your stop loss punished you for being early. Professional traders don't think this way. We don't use hard stops that sit in the market waiting to be hunted. We use something completely different, something that actually works. But before I tell you what we do instead, you need to understand why the entire concept of stop losses is flawed at its foundation. Part 2. The psychology of protection. Let's talk about why you use stop losses in the first place. Be honest with yourself. You use them because you were scared. Scared of losing everything. Scared of being wrong. Scared of what your spouse will say when you blow up the account. I'm not judging you. Fear is natural. Fear is human. But fear makes you a target in the markets. When you place a stop loss, you're making a declaration. You're saying, I will exit this trade if it goes against me by this much. Sounds logical. Sounds rational. But markets aren't logical or rational. Markets are psychological warfare. They're designed to make you do the wrong thing at the wrong time. The pain of losing money is twice as strong as the pleasure of making money. Scientists have proven this. It's called loss aversion. Your brain is wired to avoid losses more than it seeks gains. So, you place tight stops to minimize pain. But tight stops guarantee you get stopped out constantly. You death by 1,000 paper cuts yourself into poverty. I learned this lesson the hard way. Early in my career, I was religious about stops. 5% max loss on every trade, sometimes 3%. I felt so disciplined, so professional. My win rate was terrible. 30% maybe. I was right about market direction constantly, but my stops kept taking me out before the move happened. I was losing money being right. That's when something clicked. Professional traders have a completely different relationship with losses. We don't try to avoid them. We expect them. We embrace them. We know that losses are the cost of doing business, the entry fee to making real money. But we don't let the market decide when we take those losses. We decide, on our terms, when it makes sense strategically. Here's what I mean. Amateur traders use stops based on arbitrary numbers. 5%, 10%, 2 times average true range, whatever their guru told them. But why should your stop location be based on a percentage or a formula? Markets don't care about your math. They care about structure, support and resistance, supply and demand zones, actual price action. If you're going to exit a trade, exit it because the reason you entered no longer exists. Exit it because the structure broke. Exit it because new information invalidated your thesis. Don't exit it because it hit some random number you pulled from a risk management calculator. I once held a trade that went 40% against me. 40%. Most people would have been stopped out at 5 or 10. But I knew the structure, I knew the level. I knew that below my entry was a massive institutional support zone. I added to the position, averaged down strategically. That trade ended up being a 200% winner. If I had used a traditional stop loss, I would have missed the entire move. Now I'm not saying be reckless. I'm not saying ignore risk. I'm saying be strategic about risk instead of mechanical. Your brain is more sophisticated than any formula. Use it. Part 3. What professionals actually do. So, if we don't use stop losses, what do we do? How do we protect capital? How do we manage risk? I'm going to give you the exact framework I use. The same framework used by professional traders at hedge funds and prop firms. This is not theory. This is battle-tested reality. First, position sizing. This is the foundation everything else builds on. If stop losses are your primary risk management tool, you're doing it backwards. Position sizing comes first. Always. I never risk more than 1% of my account on any single trade. Never. Doesn't matter how confident I am. Doesn't matter how perfect the setup looks. 1% maximum. Here's how this works in practice. Let's say you have a $100,000 account. 1% is $1,000. That's your maximum risk. Now you find a trade. Entry at $50. Your invalidation point, the price where you know you're wrong, is at $40. That's a $10 risk per share. So you can buy 100 shares. 100 shares times $10 equals $1,000 risk. Math is simple, but notice what I said. Invalidation point, not stop loss. There's a critical difference. An invalidation point is where your thesis is proven wrong based on market structure. A stop loss is just an arbitrary number. The invalidation point might be below a major support level, below a swing low, below a key moving average. It's based on the chart, not on your fear. Second, mental stops versus hard stops. I never place a stop loss order in the market. Never. Every single one of my stops is mental. I know where I'm wrong. I have the price written down. I watch the trade. If it hits my invalidation point, I exit manually. Why? Because this gives me flexibility. The market might wick down to my level and immediately recover. If I had a hard stop, I'm out. With a mental stop, I can see what's happening. I can make a decision in real time. This requires discipline. You have to actually exit when you say you will. You can't move your stop or hope it recovers. That's how accounts blow up. But if you have discipline, mental stops are vastly superior to hard stops in every way. Third, time stops. This is something most retail traders never consider. Sometimes a trade doesn't hit your invalidation point, but it's not working. It's just sitting there, dead money. Professional traders use time stops. If a trade hasn't moved in my direction within a certain time frame, I exit. Maybe it's 3 days, maybe it's 2 weeks. Depends on the time frame I'm trading, but I don't let capital sit in dead trades forever. Time is money. Opportunity cost is real. Fourth, correlation management. I never have all my positions correlated. If I'm long 3 tech stocks and the NASDAQ crashes, all 3 positions crater simultaneously. That's not 3 separate risks. That's one risk repeated 3 times. I diversify across sectors, asset classes, and strategies. This way, my entire portfolio isn't dependent on one market scenario playing out. Fifth, scenario planning. Before I enter any trade, I map out 3 scenarios: bull case, bear case, sideways case. I know what I'll do in each scenario. If it goes up, I take profit at these levels. If it goes down, I exit or add at these levels. If it goes sideways, I use a time stop. I'm never surprised. I'm never panicked. I already made my decisions when I was calm and rational. Sixth, scaling. I don't enter positions all at once. I scale in. Maybe I start with a half position. If it works, I add more. If it doesn't work, I lose less. Same with exits. I don't exit my entire position at once. I scale out. Take some profit at the first target. Move my stop to break even. Let the rest run. This is how you capture massive moves while protecting capital. Part 4. The Risk Graph Framework. Let me introduce you to a concept that changed everything for me: the risk graph. Instead of thinking about stops as single points, think about risk as a graph, a continuum, a spectrum. At any moment, you have a risk profile across multiple positions and time frames. Your total portfolio risk should never exceed 5% at any given time. That's all your positions combined. If you have 5 positions each risking 1%, you're at maximum risk. You don't add new positions until you close something or move stops to break even. But here's the sophisticated part. As trades move in your favor, your risk decreases. You move stops to break even, you take partial profits. Your portfolio risk drops to 3%, then 2%. Now you can add new positions. You're constantly rebalancing risk across your portfolio. I keep a spreadsheet. Every day I calculate my total portfolio risk. I know exactly how much I could lose if every single position hit its invalidation point simultaneously. That number is always below 5%. Always. This is how you survive. This is how you compound capital over years and decades. The amateur trader has 5 positions, each with a 5% stop loss. In his mind, he's risking 5% per trade. Seems reasonable. But if the market crashes and all the 5 stops get hit, he just lost 25% of his account, a quarter of his capital gone in one day. That's unacceptable. That's the road to ruin. The professional trader has 5 positions, each risking 1%, but his stops are strategic. They're based on market structure. They're unlikely to all hit simultaneously unless there is a genuine black swan event. And even if they do, he's down 5%. Painful, but survivable. He'll make it back in a few good trades. Part 5. Advanced techniques for specific markets. Different markets require different approaches. The technique I use for stocks doesn't work for forex. The technique for forex doesn't work for crypto. Let me break down each market specifically. For stocks, I use a combination of technical levels and earnings catalysts. My invalidation point is usually below a major support level or below the previous earnings gap. Stocks tend to respect these levels because that's where institutions are positioned. If a stock breaks below major support, institutions are selling. I want to be out before they finish. For forex, I use time-based stops more than price-based stops. Currency pairs can chop around for weeks without going anywhere. If a forex trade hasn't worked within 5 days, I'm probably wrong about the timing. I'll exit and look for a better entry. Forex is all about timing and interest rate differentials. If the timing is off, the trade won't work. For crypto, I use volatility-adjusted stops. Crypto moves are violent. A 20% pullback in Bitcoin is normal, healthy even. So, I give crypto trades much more room to breathe. My invalidation points are based on major Fibonacci levels and previous cycle lows. I'm not getting shaken out of Bitcoin because it dropped 15% in a day. That's just Tuesday in crypto. For options, I use completely different risk management. Options have built-in risk management because you can only lose what you paid for the option. I use options for high conviction, high-risk trades where I want defined risk. But I never buy options hoping for a home run. I buy options to leverage a strong directional view while limiting downside. For futures, I use price-based stops more strictly because of leverage. Futures can wipe you out fast. I still don't use hard stops because of slippage and stop hunts, but I'm more rigid about exiting if the trade goes against me. Futures demand respect. Part 6. The Case Study Method. Let me walk you through real examples. Actual trades where traditional stop losses would have destroyed me, but strategic risk management made me money. Trade 1. Tesla in 2022. I entered Tesla at $700. My thesis was strong delivery numbers and expansion into European markets. My invalidation point was below $600, where a major institutional support zone existed. Tesla dropped to $650, then $625, then $605. Every traditional stop would have taken me out. 5% stop, out at $665. 10% stop, out at $630. But the structure held. $600 held. I held. Tesla ran to $900 within 3 months. I made 28% on a trade that most people would have stopped out of at a loss. Trade 2. British pound versus US dollar in 2023. I shorted the pound at 1.32. Interest rate differential favored the dollar. Technical resistance was strong. My invalidation point was above 1.36. The pound chopped between 1.30 and 1.35 for 3 weeks. Boring. Dead money. I used a time stop. Exited after 3 weeks at 1.31. Small loss. The pound then rallied to 1.40. My stop loss saved me from holding a losing position forever. Sometimes the best trade is the one you don't stay in. Trade 3. Apple during the 2024 correction. I bought Apple at $175. My invalidation was below 165, which was the 200-day moving average and a major volume shelf. Apple dropped to 168, then 166, stopped just above 165. Traditional stops would have taken me out, but I knew the level. I knew institutions were buying at 165. I held. Added more at 167. Apple ran to 215. I made 23% on my initial position and 31% on my ad. Notice the pattern. In every case, I knew my level. I knew where I was wrong. I gave the trade room to breathe based on structure, not on arbitrary percentages. I was willing to take heat if the structure held. This is what separates professionals from amateurs. Part 7. The Emotional Mastery Component. Here's what nobody tells you about risk management. It's not really about the techniques. The techniques are simple: position sizing, invalidation points, mental stops. A child could understand them. The hard part is the psychology. The emotional control required to watch a position go against you without panicking. When you use hard stops, you outsource your emotional control to the market. You're saying, I don't trust myself to exit when I should, so I'm letting the market exit for me. That's weakness. That's fear. And the market smells fear like a shark smells blood. Professional trading requires emotional detachment, not from money. You should care about money, but from individual trades. Each trade is just one hand in a million hands you'll play over your career. You're going to lose some hands. That's guaranteed. The question is whether you lose them strategically or lose them stupidly. I've trained myself to watch positions go 10% against me without flinching, without checking the chart every 5 minutes, without lying awake at night. How? Because I know my risk. I know my invalidation point. I know that even if this trade hits my stop, I'm only down 1%. 1% is nothing. 1% is noise. I'll make it back on the next trade. This emotional mastery only comes from proper position sizing. If you're risking 5% or 10% per trade, you can't have emotional detachment. You'll be terrified. You'll be checking your phone constantly. You'll be making emotional decisions. But if you're risking 1%, you can be calm. You can be strategic. You can trade like a professional. I meditate before the market opens. 10 minutes of breathing exercises. I visualize my trades. I visualize them working. I visualize them failing. I visualize myself executing my plan either way. This mental rehearsal makes the actual execution automatic. No hesitation, no panic, just execution. Part 8. The Compounding Advantage. Here's the mathematical reality that should convince you forever to abandon traditional stop losses. Compounding requires consistency. You can't compound if you're constantly getting stopped out of winning trades early. You can't compound if you're taking unnecessary losses. Let's run the numbers. Trader A uses 5% stops. He has a 50% win rate. His average winner makes 10%. His average loser loses 5% because of his stop. Over 100 trades, he wins 50 trades, making 10% each, which is 500% total gain. He loses 50 trades, losing 5% each, which is 250% total loss. Net profit is 250% on 100 trades. Sounds decent, right? But Trader A got stopped out of 20 trades that would have been winners if he'd given them more room. His actual win rate should have been 70%. Those 20 trades cost him 200% in misstated profits. His real performance should have been 450%, not 250%. He gave up 200% of gains to stop losses. Now, Trader B uses strategic invalidation points, risks 1% per trade, has a 60% win rate because he doesn't get stopped out prematurely. His average winner makes 15% because he lets them run. His average loser loses 3% because he exits strategically, not mechanically. Over 100 trades, he wins 60 trades, making 15%, which is 900% total gain. He loses 40 trades, losing 3%, which is 120% total loss. Net profit is 780%. Same market, same opportunities, different approach. Trader B more than triples Trader A's returns. That's the power of strategic risk management versus mechanical stops. And this compounds year after year. Over a decade, Trader A turns 100,000 into maybe 500,000. Trader B turns 100,000 into several million. Same intelligence, same work ethic, different risk management philosophy. Part 9. Building your personalized system. Everything I've told you needs to be customized to your personality and trading style. I'm going to give you a framework to build your own strategic risk management system. Step 1. Track your last 50 trades. Don't have 50 trades yet? Start tracking now. For each trade, note your entry price, your exit price, your intended stop level, whether you were stopped out, and whether the trade would have worked if you'd held longer. Be brutally honest. This data reveals your patterns. Step 2. Calculate your premature stop-out rate. How many trades were stopped out that would have been winners? If it's above 20%, your stops are too tight. You're costing yourself money. You need to give your trades more room based on structure. Step 3. Analyze your average loss on losing trades. If you are consistently losing more than your intended risk, you have a discipline problem. You're not honoring your stops. You need mental stop discipline, or you need to use hard stops temporarily until you build that discipline. Step 4. Identify your invalidation philosophy. Are you a technical trader? Your invalidation points should be based on support and resistance breaks. Are you a fundamental trader? Your invalidation points should be based on news or earnings that contradict your thesis. Match your stop methodology to your trading style. Step 5. Set your risk parameters. 1% per trade, 5% maximum portfolio risk. These are my numbers. Yours might be different if you're more or less risk tolerant, but they should be written down. They should be rules, not suggestions. Step 6. Create a trade journal template that includes your invalidation point, your position size calculation, your risk in dollars, and your scenario plans. Fill this out before every trade. If you can't fill it out, you don't take the trade. Step 7. Review weekly. Every Sunday, I review every open position. I recalculate my portfolio risk. I adjust invalidation points if structure has changed. I take partial profits where appropriate. This weekly review keeps me honest and strategic. You came here thinking stop losses protected you. Now you know better. Stop losses are the market's way of extracting money from people who are almost right. They punish you for being early. They reward the patient and the strategic. What I've given you today isn't a hack or a trick. It's a complete philosophical shift in how you approach risk. Stop thinking about protection. Start thinking about strategy. Stop outsourcing decisions to mechanical systems. Start using your brain. Will this be comfortable? No. Will you doubt yourself? Absolutely. The first time you watch a position go 15% against you without a hard stop, your palms will sweat. Your heart will race. You'll want it to click that sell button. Don't. Trust your invalidation point. Trust your structure. Trust your process. The professionals aren't smarter than you. They're not luckier. They don't have better information. They just have better risk management. They understand that trading is a game of survival first and profit second. Survive long enough and profits are inevitable. You now have the same framework used by hedge fund traders and proprietary firm professionals. The same framework that's made millions of dollars over decades. But knowledge without action is worthless. What you do next determines everything. Tonight, review your current positions. Identify your real invalidation points based on structure. Calculate your actual portfolio risk. Make it concrete. Make it real. Then tomorrow, start trading like a professional. No more arbitrary stops. No more feeding the machine. Just strategic, intelligent risk management. The market will still try to shake you out. It will still hunt for stops. But your stops won't be there waiting. You'll be positioned strategically. You'll be thinking clearly. You'll be trading with confidence because you know exactly what you're doing and why. This is your edge. This is what separates you from the herd. Everyone else is using stops. You're using strategy. Everyone else is scared. You're calm. Everyone else is getting stopped out of winners. You're riding them to massive profits. Welcome to professional trading. Your journey starts now.